Have you ever wondered if you're paying more taxes than you legally have to? Every year, millions of Americans rush to file their tax returns, assuming nothing has changed. They open their favorite tax software, answer the same questions as last year, click submit, and hope for a refund. But this year is different. Several important IRS changes could affect your refund, your tax bill, and even whether you qualify for valuable deductions. Missing just one update could cost you hundreds or even thousands of dollars. That's why today we're breaking down the new IRS rules every taxpayer needs to know before filing. Whether you're an employee, freelancer, retiree, investor, or small business owner, these updates could have a real impact on your finances. By the end of this video, you'll know exactly what changed, how those changes affect you, and what smart taxpayers are doing before they file. Let's get started. One of the biggest changes involves the standard deduction. Since most Americans claim the standard deduction instead of itemizing, this update affects millions of taxpayers. The deduction amount has increased because of inflation adjustments and recent tax law changes. That means more of your income may be shielded from federal taxes before your tax bill is even calculated. For many households, this translates into lower taxable income and potentially a larger refund, depending on your overall financial situation. The IRS has published updated deduction amounts along with revised tax brackets and inflation adjustments. IRS Plus 1 tax brackets have also been adjusted. Many people mistakenly believe that getting a raise automatically pushes all of their income into a higher tax bracket. That's simply not how the American tax system works. The United States uses a marginal tax system, meaning only the income that falls within each bracket is taxed at that bracket's rate. Because the income thresholds have increased, some taxpayers may owe less federal tax than they expected, even if they earned more money than last year. Understanding this simple concept helps prevent unnecessary fear about raises, bonuses, or overtime pay. IRS Plus 1. Another major update involves new deductions introduced under recent tax legislation. Depending on your situation, certain taxpayers may qualify for deductions related to qualified tip income, qualified overtime pay, or eligible car loan interest. These deductions have specific eligibility rules, income limits, and documentation requirements, so keeping accurate records is more important than ever. If you simply assume you qualify without checking the details, you could end up making costly mistakes or missing valuable tax savings. IRS Plus 1. Families should also pay close attention to updated rules surrounding tax credits. Certain credits now require valid Social Security numbers or individual taxpayer identification numbers issued before the filing deadline. If this requirement isn't met, taxpayers may lose access to credits they expected to receive. Since tax credits reduce your tax bill dollar for dollar, they are often far more valuable than deductions, making it critical to verify eligibility before submitting your return. IRS. If you earn money through freelance work, ride-sharing apps, food delivery, online marketplaces, content creation, or any type of gig economy job, don't assume the IRS can't see your income. Even if you don't receive every tax form you expect, you're still legally required to report all taxable income. Many taxpayers mistakenly believe that no tax form means no tax obligation. That's one of the fastest ways to trigger IRS notices. Always keep your own income records throughout the year, instead of relying entirely on forms sent by companies. IRS cryptocurrency investors also need to be extra careful. The IRS continues to require taxpayers to answer questions about digital assets on Form 1040. Whether you bought, sold, exchanged, received, or otherwise disposed of cryptocurrency or certain other digital assets, those transactions may need to be reported. Some taxpayers will also receive new reporting forms from brokers. Ignoring crypto activity has become much riskier as IRS reporting requirements continue to expand. IRS. Finally, before you even think about filing, log into your IRS online account. Many taxpayers discover missing payments, estimated tax records, notices, or account information only after filing. Reviewing your account beforehand can help prevent delays, amended returns, or refund problems. The IRS also encourages taxpayers to choose direct deposit whenever possible, as electronic refunds are generally much faster than paper checks. Now let's talk about retirement accounts, because this is one area where many Americans accidentally leave money on the table. If you contribute to a traditional IRA or a 401k, updated contribution limits and eligibility rules could affect both your current tax bill and your long-term retirement savings. Every dollar you contribute to certain retirement accounts may reduce your taxable income today while helping your investments grow tax-deferred for years. Many high-income earners legally reduce their tax liability simply by maximizing these retirement contributions before the applicable deadlines. Even if retirement feels decades away, understanding these rules today can save you thousands over your working lifetime. The IRS has also updated contribution limits for retirement plans and inflation adjustments for many tax-related thresholds. Source: IRS Retirement Plan Updates. Health savings accounts, commonly known as HSAs, continue to offer one of the most powerful tax advantages available. If you're covered by a qualifying high-deductible health plan, contributions to an HSA may be tax-deductible, investment growth inside the account can be tax-free, and qualified medical withdrawals are generally tax-free as well. That's why many financial planners refer to HSAs as offering a triple tax benefit. However, contribution limits are adjusted periodically, so it's important to verify the current year's maximum before filing your return. If you're a homeowner, there are several deductions and credits worth reviewing carefully. Mortgage interest may still be deductible for eligible taxpayers who itemize, and certain energy-efficient home improvements may qualify for federal tax credits if they meet IRS requirements. Installing qualifying solar panels, energy-efficient windows, heat pumps, or other approved improvements could reduce your federal tax bill. Many homeowners spend thousands on upgrades without realizing they may qualify for valuable tax incentives. Small business owners should also pay close attention this filing season. Whether you operate a consulting business, sell products online, drive for rideshare companies, or own a local business, keeping accurate records has never been more important. The IRS expects taxpayers to maintain documentation supporting business expenses, mileage, equipment purchases, advertising costs, home office expenses, and other deductions. Claiming deductions without proper records can create problems during an audit, while maintaining organized documentation makes tax filing much smoother. Speaking of audits, many people panic whenever they hear the word IRS. The reality is that most taxpayers are never audited, but certain mistakes can increase your chances of receiving additional questions. Large mathematical errors, inconsistent reporting, forgetting to include income reported on forms like W-2s or 1099s, claiming unusually large deductions without documentation, or entering incorrect Social Security numbers can all create unnecessary complications. Carefully reviewing your return before submitting it is one of the simplest ways to avoid delays in correspondence from the IRS. Another important reminder involves estimated tax payments. If you're self-employed, receive significant investment income, or earn income without withholding, you may need to make quarterly estimated tax payments throughout the year. Waiting until tax season to pay everything at once could result in underpayment penalties. Many freelancers and independent contractors overlook this rule during their first year of self-employment, only to receive an unexpected tax bill later. Tax scams continue to evolve every year, and criminals frequently impersonate the IRS through phone calls, emails, text messages, and social media. Remember that the IRS generally begins official communication through mailed notices, not threatening phone calls demanding immediate payment with gift cards, cryptocurrency, or wire transfers. If you ever receive a suspicious message claiming to be from the IRS, verify it through your official IRS online account or consult a qualified tax professional before taking any action. One of the smartest habits you can develop is keeping tax records organized throughout the year, instead of scrambling at filing time. Save your W-2s, 1099s, charitable donation receipts, mortgage statements, investment documents, medical expense records where applicable, and any paperwork supporting deductions or credits. A simple digital folder can save hours of frustration when tax season arrives and significantly reduce the chance of overlooking valuable tax benefits. Many taxpayers also make the mistake of filing too quickly. While everyone wants their refund as soon as possible, rushing can lead to missing documents or filing before all income statements arrive. If a corrected tax form is issued after you've already filed, you may need to submit an amended return, creating additional paperwork and potentially delaying your refund even further. As you get closer to filing your return, remember that tax software is a tool, not a substitute for understanding your own finances. Programs can calculate numbers accurately, but they only work with the information you provide. If you accidentally leave out income, forget to claim a deduction, or answer a question incorrectly, the software cannot magically fix those mistakes. That's why taking a few extra minutes to review every section before clicking File can make a significant difference. Compare this year's return with last year's, verify your personal information, double-check your bank account details for direct deposit, and make sure every W-2, 1099, and other tax document has been entered correctly. If you're expecting a refund, it can be tempting to think of it as free money. In reality, a tax refund usually means you paid more tax throughout the year than you actually owed. While receiving a large refund feels exciting, some financial experts recommend adjusting your withholding so you keep more of your paycheck during the year instead of giving the government an interest-free loan. Of course, everyone's financial situation is different, but understanding why you receive a refund is just as important as receiving one. For investors, tax reporting has become increasingly important. Capital gains, dividends, interest income, and brokerage transactions all have different tax implications. Selling investments at a profit may create capital gains taxes, while selling at a loss could potentially help offset taxable gains in certain situations. That's why many experienced investors pay attention to tax-efficient investing, rather than focusing only on investment returns. Keeping detailed records of your investment activity throughout the year makes tax season much less stressful. Parents should also review every education-related tax benefit they may qualify for. Depending on income and eligibility requirements, education credits and deductions can significantly reduce a family's tax bill. Whether you're paying college tuition, contributing to education savings, or supporting a dependent, reviewing available tax benefits before filing could save hundreds or even thousands of dollars. Missing these opportunities simply because you didn't know they existed is one of the most common filing mistakes. If you've experienced a major life change during the year, such as getting married, divorced, having a child, changing jobs, buying a home, retiring, or starting a business, your taxes may look very different from previous years. These life events often affect filing status, deductions, withholding, credits, and reporting requirements. Never assume this year's return should look exactly like last year's. Even one major life event can completely change your tax situation. Another growing trend is identity theft related to tax refunds. Criminals sometimes attempt to file fraudulent tax returns using stolen personal information before the legitimate taxpayer files. One of the best ways to protect yourself is to file once you have all of your correct tax documents. Safeguard your Social Security number. Enable strong security on your financial accounts, and monitor your IRS online account for unusual activity. Preventing identity theft is much easier than resolving it after fraudulent returns have already been submitted. Perhaps the biggest takeaway from all of these new IRS updates is that being proactive almost always pays off. Waiting until the last minute creates unnecessary stress, increases the likelihood of mistakes, and leaves little time to correct missing information. Successful taxpayers treat tax planning as a year-round habit instead of a once-a-year event. They keep organized records, understand the deductions and credits available to them, contribute consistently to retirement accounts, monitor changes in tax law, and review their finances before filing season ever begins. Taxes may never be anyone's favorite subject, but understanding the rules puts you in control of your money. Every dollar you legally save is a dollar that can be invested, used to pay down debt, build an emergency fund, or move you one step closer to financial freedom. The IRS updates its rules regularly, and staying informed is one of the smartest financial habits you can develop. Instead of fearing tax season, use it as an opportunity to improve your financial health and make more informed decisions throughout the year. If you found this video helpful and want more easy-to-understand explanations about taxes, investing, credit scores, passive income, and smart money strategies that can help you build long-term wealth, make sure you subscribe to the channel and turn on the notification bell so you never miss a future upload. If you learned something new today, let us know in the comments which IRS update surprised you the most, and share this video with someone who plans to file their taxes soon. Thanks for watching, and I'll see you in the next video.